Yeah, look, I've actually had one in our practice, and justifiably asking a little bit about whether or not we should have made a decision a couple of days ago to move out into cash. And the consistent message that I've been delivering to my clients is essentially that we started an investment program many years ago to meet a certain objective, which is based upon the longer term. And of course, what we're seeing at the moment is some short-term volatility, and I think one of the easiest things would be to actually make change, but in some ways the hardest thing would be to actually make no change if we believe in our original investment strategy. So I think with my clients it's important to sort of work out whether or not the original investment strategy meets the brief in terms of meeting their objectives, and also looking at whether the risk characteristics of a portfolio are right, or are a match for the clients. So obviously for certain clients that want to have a fairly significant amount of money in cash and bonds to have relative immunity from a downturn like we're seeing at the moment. And so I suppose the reason why we haven't had so many calls is because you set up the program right to begin with, and you can see it out the distance. Well, yeah, absolutely. People who have a long-term plan where their original investment strategy was based upon, a rigorous, academically tested investment program should have no issue. I think the fear and greed cycle is at play here. When we have higher prices, people are elated and they want to put money into the market, and when the market is dropping and people get fearful, they want to take it out. So it's really buying at highs and selling at lows, which is, if you keep repeating that cycle, you'll be pretty broke in no time. Well, it's all about the original conversation that you have and the expectations. When you set up a portfolio, you have defensive assets and you have growth assets. And the defensive assets, I like to speak of them as a merry-go-round, where they just go round and round and round, but they don't give you a great high return. And then you've got your roller coaster, which is your growth assets, goes up and down. If we back test our portfolios and have a look at how they've actually predictably moved in the past, then we can actually explain to our clients and talk to them about what would happen if a negative 30% drop occurred on their portfolio, and how would they feel about that. Now, having those conversations early means that you're able to determine what is the right portfolio for your client, and that when you consistently deliver the same message that was originally given, calm sets in and a panic is allayed.
The Australian share market has staged a stunning turnaround after yesterday's massive fall, rising more than 2.5%. But investors are being urged to remain cautious, especially those at retirement age. Brett McLeod has the latest.
Armidale Bowls Club is not exactly the trading room floor, but it can sound like it.
Macquarie is up 5%. That's incredible. They're incredible moves on the market.
The stock market rollercoaster means a great deal to these self-funded retirees.
Very worrying, because the total value of all of my shares have gone down, so we rely on the return we get on those shares to basically live.
The closing bells on Wall Street overnight sounded more like alarm bells, an initial 1,000-point fall leading to fears of more carnage here this morning. China opened the day positively, but within minutes, whatever optimism there was crashed and burned, the market dropping another 7%. The Prime Minister tried to calm nervous investors.
I think it's important that people don't hyperventilate about these things.
And when our market opened...
A bit of buying coming into the market this morning.
And here's how the day unfolded. Straight after the market opened, it fell another 1.5%, dropping below 5,000 points for the first time in 2 years. But then the buyers came in. There were a few dips on the way, But those discounted prices proved too good to resist.
The banks were savage yesterday. There is a buying opportunity there. There was a lot of fear selling, a lot of pulling out, and there will be bargain basement price buying.
The underlying fundamentals of the economies in this part of the world, they're still pretty good. And I'm not too concerned.
Financial advisors have been telling their clients to stick with their plans through what promises to be a volatile period.
You set up the program right to begin with, and you can see it out the distance.
And unless you're going to sell your shares and you need to sell the shares to get money, you're no worse off at the present time.
No hyperventilating here. Brett McLeod, 9 News.